the fine print as well. We are going to look at the devil in the data by exploring the core principles of building high quality greenhouse gas inventories, and we will ground this in a real world case study involving the UK automotive manufacturer Vauxhall Motors. So before we look at the case study, we need to understand what actually makes a greenhouse gas inventory high quality. So according to the standard corporate accounting frameworks, a successful program relies on four interlocking pillars. First is data. This means collecting accurate, complete, and relevant activity data like flight miles or fuel consumed. Second is methods, applying the correct mathematical calculation models and emission factors to that data. Third is systems. So utilizing robust IT and data management platforms to securely capture the information. And finally, documentation. So maintaining transparent records of all assumptions and processes to enable successful internal and external audits. If any of these four pillars fails, your entire carbon footprint is compromised. To see exactly how these elements interact in the real world, let's look at what happened at the Vauxhall Motors. So Vauxhall was setting up a system to track the carbon footprint of their business operations. And specifically, they were looking at the emissions generated by their staff's air travel. They set up a system to track the data. However, a massive flaw was introduced during the data entry. They were only calculating the flight distance for one-way trips, completely forgetting to factor in the return flights. Because a round trip is exactly double the distance of a one-way flight, this error meant their final emission output will be exactly 50% lower than reality. But here is why the framework matters. Vauxhall did not just blindly publish the numbers, they had a rigorous documentation and methods review process in place. And by auditing their own assumptions, they caught the mistake internally before the data ever went public. So the framework did its job and prevented a massive reporting failure. Why is it so vital to catch these errors? So, staff air travels falls under scope 3 emissions, and these are the indirect emissions in a company's value chain. And they are difficult to track because they rely on human data entry and third party vendors. So, if Vauxhall had published that flawed data, they would have established a false baseline. Greenhouse gas accounting relies on accurate historical data to measure the future progress, right? So, if your baseline is artificially low, your future reduction targets become completely meaningless. Furthermore, if auditors or regulatory bodies had discovered this 50% discrepancy after publication, so Vauxhall could have faced severe accusations of greenwashing and suffered massive reputational damage, right? Because Vauxhall takes their GHG inventory seriously, so they are able to confidently execute a massive sustainability transition today. So now operating as a vital part of the global Stellantis group, Vauxhall is targeting carbon net zero by 2038 with a milestone to cut absolute emissions in half by 2030. And they tracking emissions, they are actively changing how they build. They have successfully transformed their historic Ellesmere port factory into the UK's first dedicated electric vehicle manufacturing plant. And today they offer a highly strategic multi-energy lineup. These includes expanding their zero emission fleet with Corsa, Astra, and Frontera electric models, while also offering highly efficient plug-in hybrids to meet the current consumer demand and smoothly transition the market. So here are some key takeaways that from this case study. To wrap up, this leaves us with the three major takeaways basically. Number one is trust the framework. So data and system are completely useless if you do not have the methods and documentation in place to audit them. Number two is assume nothing. Always double check the parameters of your data. A simple missed variable like a written flight can invalidate an entire sustainability report. And number three, last, is measurement drives action. Today, Vauxhall relies on precise carbon accounting to manage their massive transition toward electric vehicles, and you cannot achieve a net zero future without foundation of just a moment. Yeah, I was saying that today Vauxhall relies on precise carbon accounting to manage their massive transition towards electric vehicles, and you cannot achieve a net zero future without a foundation of perfectly accurate data. So, this is all. Thank you so much for your time.
Thank you, Nikita. Good work done. So that's the takeaway. Wherever data is being questioned, make sure that the sanctity of data, that how you are developing that data, where you are storing, how you are using, which methodology you are covering with, is properly maintained. So great job done. Thank you. Let's go to the next speaker. Ramlan ji, are you? Are you going to present?
Yeah.
Okay.
And also, thanks to Ramrendra ji. Actually, I took his advice. Like on the group, he gave me the suggestion, so I took that into consideration, and based on that, I prepared this presentation. So, thank you, Ramrendra ji.
Most welcome.
He's a
No
team member.
problem.
He's a team member. Great, great.
Okay, so is my screen visible and am I auditing?
Yes, just make it full screen and go ahead.
Screen. My system is a bit slow. So we go ahead with this. My system is a bit slow because
Yeah, go ahead.
Yeah,
It's not
because I
waste
don't
time.
want to waste time. Yeah. Good evening, everybody. Just to set the context, I'm presenting here as the Chief Knowledge Officer for Strategy and summarizing the carbon auditing of 2014 to 2003, create an overview of that. And the audience is the CXO board members. So this presentation is totally for the CXO level, not the mid management level, a junior level. So it's very, you know, high level. So as an executive team, so now I'm addressing the audience. Okay. As an executive team, we strictly monitor the market condition, various business issues, consumer demands, competition issues. But today,
Sir, sorry, can you speak up a bit more?
Okay, yeah. So today I want to map out a massive operational transition that has occurred apart from the regular business issues that we deal, which is basically the hardening of carbon accounting from voluntary internal CSR exercise, which was phase one, to phase three, which is becoming mandatory because of various regulatory issues and other issues, which I will explain during the course of the meeting. So for this presentation, I have taken help from PwC, who is also the auditor of or verifier of our GHG accounting reporting. And what in one line, if I would summarize, what they say in very unambiguous, uncertain terms, the era of best effort corporate sustainability from reporting is officially. Today, greenhouse accounting is being restructured to match the exact precision, audit rigor, and level of accountability which a financial balance sheet demands. So that's a big change, and we should all be aware of it, and you should all be aware of it so that we can take the necessary steps. So let's start with firstly the good news. One is that for years there used to be struggle to measure specifically the non-CO2 greenhouse gases and complexity related to industry level specifications, the mathematical modeling, and all that. But this has considerably come down large extent because of standardization driven by GHG Protocol for Corporate Standards. So standardization usually acts as a force multiplier, as you are aware, because it ensures the data quality, ensures the process alignment. And one of the cleanest case study which we have seen, which is mentioned very briefly on the slide, is in the cement sector because of introduction of the PCSB, which is very, very specific to the cement sector. It has changed the cement sector's reporting the confusion completely. So therefore, to sum up this particular slide, standardized uniformly is our only path to the data that we can legally stand by. So this is the next slide. Again, there's a little problem. We could see that in terms of that. So that however, as we look at our own operational footprint based on the last slide, I think there are 4 areas which require immediate attention. This particular slide basically present the key risk areas on the y-axis, the impact and predictability of the x-axis. Therefore, obviously, which is important one, which is medium impact, medium predictability, etc. I'm not going to go over the read of the slide, obviously. So the issues are, one is, first one is the waste field, as far as our operation is concerned. Why? Because the inputs vary quite a lot, and therefore the emission standard, which is not fixed, kind of it depends on the inputs. Second is cogeneration, for example, electricity and heat cogeneration. So both are actually helping us to reduce the emission in terms of going in for a lower carbon emission electricity generation, as well as utilizing the waste heat for generating further carbon reduction activities like heating, etc. But however, clear distinction between the two and how much to contribute to which one of them becomes a problem. Third and the fourth, which are more or less it's related to the passenger travel, shipping, etc. So these are high impact, high predictability issues, mainly because there are regulations which are coming up and they will become mandatory to report in a particular framework. ES is one example for compliance, and accordingly, various national other auditing methods. For example, UK and I believe California also through CCA also have come out with specifications in terms of reporting these areas, so that we don't have an excuse that it's difficult to collect data, but even doesn't always that. So for most importantly for us in this room, for the audience in this room, is the verification is moving into a strict legal film. So just to conclude, I would say that we need to proactively audit our operations and supply chain today. Can't wait for tomorrow. Specifically targeting these volatile areas which are mentioned, industrial coding and logistics, to ensure that our internal metrics can withstand the rigor of our state accredited national audit. So that's all. Thank you very much. I hope I have clearly if there's any question.
Yeah, it was great job, Ramrendraji. Your suggestions and your summaries are always great. In 2 slides, you have summarized everything. Um, Presentation has successfully communicated the strategic importance, obviously, of the ongoing transformation of carbon accounting, and specifically how verification is taking the center stage. So I love that part. Technical calculation methodology, I agree, has to be emphasized with the governance, business risk, and executive accountability. PwC case is one of those important cases. Even CXO wants to learn about it in the sustainability industry because of the three reasons which I know. One is that it helps you to understand that why quantification of business impact is important, right? Then only you can do the assurance, right? And second, that how this case study establishes the fact that you define an executive call to action. That why in next 12 to 14 months, any company's leadership should prioritize the GHG accounting. And the timeline which you in the beginning, in the first slide you have shown, of course, that is in relevance to the PwC was, right? Initially, it was voluntary for them, and then from 2021 onward, it became mandatory. But that actually gives an idea that you have to have a strategic narrative around whatever initiative you take in your company, because end of the day, company wants operational efficiency, resilience, and end of the day, the people who invest also need a confidence. Hence, auditing part, which you have highlighted, which reinforces that there is an important shift happening. And that's why anybody who is learning this, people who are not coming or giving excuses that they are busy and all that, I totally understand. But they are, life happens, but they can't forget such kind of input. See, if they could have been here today, Ramrenji, then learning could have been peer to peer, right? That is phenomenal learning. They are not understanding that part. So you can't change the world. We will change ourselves, which you have done today, presented it. And see, the learning is verification readiness is now core capability. Yeah, that's what you have indicated, and they have missed that, and they are going
Yeah,
to miss
so
that.
the whole thing is that like it should be part of the board's like audit committee or risk management committee, etc. Part of their agenda.
Indeed, I agree with you. Thank you very much, Ramrenji and Nikita. Please, guys, please clap for both of them. Yeah. Thank you. You can stop sharing, and now third person will go. Great, great, Dhanasi. Thank you. Who is going next? Who is going next?
I can go next, sir.
Yeah, Manrend, go ahead. Your screen is not shared, Madhurendra, and we are not able to hear you. I hope you
Yeah,
are trying to share your screen, right?
yeah, I'm trying to share it.
Okay. Yeah.
I should share the entire screen, right?
Yeah, you should share the presentation which you have prepared. Yeah, we can see it.
Is that right?
Just make it full screen so it will be easier to see. Otherwise, it becomes very small. Yeah, yeah. Yes, go
Okay.
ahead. Go ahead.
Okay. So I did not participate in the last last presentation. So Mr. Vivek sir suggested me to go for 2 topics, 2 boxes, but I have gone for 3, one upping him. So the first case study is of BP. They have they have started very early in accounting of their emissions, in calculating their emissions. But in calculating any emission, if your company is very big, then you need to decide how will you uh, try to account the emissions. Do you account facility wise, or do you account centrally? If you go for accounting facility wise, then you need to train a lot of staff, and you need to impart a lot of tools, and you need to give them a lot of tools so that they can do it accurately. And also you need to bring in audit form so that everything what they have reported is audited. So BP has done it centrally. They started in 1997. So furthermore, we can see that they have enforced a uniform BP GHG reporting guidelines. So it is very mm, uh, right to do it, because in GHG reporting there may be several things which may be out of a scope for what the company is doing. So they have personalized it, and through them they are reporting it, and they are doing it unit wise. So they have a central team of 320. They had a central team of 320 individuals which were reporting it, and to collect data, they started. They distributed a quarterly pro forma, and uh, and they uh, and they collected data quarterly, and they compiled it, and also they are auditing it. So this was what they did in 1997, and today they have a net zero target by 2050, and by 2025 they have achieved 37% reduction in S1 and S2 scope emissions, and they are still continuously quarterly monitoring it. So going on to the next box, this is a case of United Technologies. It is one of the it highlights one of the GHG protocols, that you need to calculate the what you think is a very minuscule amount of emissions. Only when you calculate, then only you can know that it is minuscule and we can ignore it, right? So uh, what they were doing is they were transporting their engines, and during the transportation of engines, they thought that it was the emissions were very less. But they when they started to count it, it came to about 19 to 30% of their annual emissions. Currently, UTC is now RTF Corporation, and they have a science-based decarbonization target, pursuing 2.9% annual reduction target. And furthermore, one of the very attractive things is that they have set this target with no more than 10% of carbon offsetting. My third case is case of Endesa. So they have sold a power generation company in Spain in January 2002. They have sold 87.5% of their stake. So it highlights the GHG accounting principle, that if you are restructuring your company, then you need to alter your baseline emissions. So how do you alter your baseline emissions is a figure 7 and figure 8. It is shown here. When you figure 7 shows when you are disinvesting, and figure 8 shows when you are when you are doing an acquisition. So in figure 7, it shows that if you are deinvesting, then uh, you should alter your baseline such that the particular company which you are deinvesting was never there. Otherwise, it will show that year on year you have reduced significant amount of carbon with no overall effect in the in the grand scheme of things, that is in the on the planet. Secondly, if you are acquiring a company, then you must reset reset your baseline emissions such that the company was there when you were doing your baseline emissions. Right. So this is the end of my presentation. Thank you. Hello.
No, great job, Madhurendra. Thank you very much for covering for others who could not complete their work. And as well as you, last time you didn't do. So it was not punishment for you.
No,
Actually,
no,
it
it was
was.
not punishment, sir. I read it. Read that report, and I found many things. Actually, I thought that Microsoft report could have been done in 2 or maximum 3 pages, but they have made
No,
it
no,
very
good,
long. And
good, good.
so I wanted to talk about it, but unfortunately, I had to go to the hospital. So
No, no, I
it's
totally
okay.
understand. And
Yeah.
nevertheless, I can see your skill here. You have done three different case study. People must have appreciated in the same time you have covered three. And that covers the full part. The best part is that we are covering the book by example. And that, Madhurendra, your contribution will be remembered throughout the course because you covered this 30, 40 pages, learning in three examples. And the best part of presentation was that you have demonstrated that if anyone, be it Yashwant, Nikita, myself, Ramnendra, if we do GHG accounting successfully, it should not be only technical success, right? Methodologies and all that learning which we are doing, but also governance, organization design, strategic decision making is what makes this exercise success, right? That is what these three different case study of the three different part of GHG accounting talks about. For example, BP and United Technology RTX, which you talked about along with Endesa. I love the Endesa case study, by the way, right?
Yes.
Because they illustrated how such kind of leading organization today have institutionalized the carbon accounting, right? So if they are taking over any company, they know that they need to reset their baseline. There are four different cases where you can deploy restatement, and one of those example you have just cited that when you are acquiring a company, you have to reset the baseline of the whole company when after acquisition, right? So again, for that you need a centralized governance system, comprehensive emission identification process, and a robust treatment of the organization changes. So awesome job. I believe everybody must have got benefited, and that is what I was telling you guys, right? Let people who cannot come, they cannot come. We cannot force everybody. You paid money, you come on time, you prepare your case study. If I am not giving you opportunity, then you talk to me, right? So who got benefited? People who joined today. I can only give opportunity. I cannot, force them to come to classes or teach them something what is ethics and what is not ethics. They knows and they are stuck with their life. Life happens with everyone. So I allow them. Excuse me for that. I'm not lenient here. But every human being is different, and life happens with everyone. So let's allow them for first few sessions. After that, they do. It's up to them. They will lose it. But great job, Madhurendra. Great job. Thank you.
Thank you so much.
Guys, please appreciate your team member has done such a hard work. Yeah. Please give a clap for him. Please give a clap. Yashwant Ramnenji, please give a clap. Yeah. Great. Skalpak, Nilesh, Dhansri. Okay. See, the biggest disadvantage person is Dhanyasri. Her group sees only one flag bearer. Yeah, nobody else could come. Somebody's in office, somebody traveling. We can't help.
I am from group one, sir. I think I am
Actually,
from.
you
Yeah,
are
yeah,
also good
yeah,
from.
yeah.
Yeah,
Okay, great,
I
great.
am with her.
Okay, awesome. Okay, who is going next now? Madhurendra?
I think I'll go next, sir.
Oh, please go ahead. Go ahead.
Um, is my screen visible?
Yes.
Yes, okay. Um, so, hello everyone. I'll be presenting today about the Royal Dutch Shell case study. So it is a So Royal Dutch Shell, it is a global energy and petroleum company, and they engage in crude oil and natural gas exploration. And recently, they have also been in investing in renewable energy sector as well, because they want to transition towards sustainable energy and resources. So they are focusing on energy transition. So they were formed in April 1907, and it's a merger of two companies, one from Netherlands and one from United Kingdom. Royal Dutch Petroleum Company from Netherlands and the Shell Transport and Trading Company of the United Kingdom. They merged together and formed this energy and petroleum company. And here, the Royal Dutch owns 60% of the stock ownership. I think it was when they formed the company, it was 60%. I'm not sure how much it is now. And they report their GHG emissions based of the operational control approach, and this reporting of like 100% of all these ventures, it's under operational control, irrespective of its shares in the equity capital. And this also ensures that the GHG emissions reporting is in line with its operational policy, including the health, safety, and environmental guidelines. So this is the EHS guidelines. So they follow GHG inventory along with EHS, as well as they also prepare it in line with ISO 16064-1. Um, and like when I looked into their annual report, specifically the sustainability part of it, so they have this boundaries set. So scope 1 and scope 2 is reported by following the operational control, and scope 3 is from based on the equity boundary. So in this scope 1, it reflects their ability to directly control operations by applying their own operating policies and standards. And in this, they account for 100% of their emissions from assets and activities that are under their control, irrespective of their ownership percentage. So basically, the assets which come under this operational control is first one is assets which are whole, like completely owned by Shell, and next is whichever they have been designated as an operator. So joint operations, and based on their arrangements or contracts, if they have an operator role under it, so it comes under their control, operational control. And next is their assets leased and uh, other things that is operated by Shell. For example, leased maritime vessels. Here, Shell holds the safety management document of compliance, so they are like yeah, they look after the operational control here. And scope 6 is for they follow the equity boundaries. So in this part, they report the share of emissions from energy products that is sold, and this includes third party that they are sourced from their companies. And so when we look into their whole ambition or targets for the upcoming years. So they want to achieve net zero emissions by 2050 in all scope 1, 1, 2, and 3. So if we can look at the scope 1 and scope 2 emissions, so they are planning to reduce like half of the reduction compared to the 2016 one. So they keep 2016 as their baseline. So they want to reduce it by 50% by 2030 and bring it to zero by 2050, like 2050. And they have eliminated routine flaring by this 2025 year. And they are also like maintaining like lesser methane emissions, which is below to 0.2%, and they want to bring it to net zero by 2030. And if we look at their scope 3 emissions, which come under equity boundary, so here they want to reduce the net carbon intensity, which is NCI. They want to bring it to 100% uh, like reduce it completely by 100% in 2050, and also reduce the consumer emissions from use of their oil products up to like 15 to 20% by 2030. So they are planning to do this by promoting like decarbonize their um, energies. So, for example, maybe by substituting use of coal with LNG, replacing internal combustion engines vehicles with electric vehicles. So basically this, and I also just looked into the ratings, the reporting ratings, which sir had mentioned last time. So I just thought of looking to it. So this is the score of their ratings for the sustainability reports. So yeah, this is all that I want to present today. Thank you.
Great job, Dhanasri. You definitely good. Madhurendra is clapping before only. Really awesome, to the point, discussion on Royal Dutch Shell and their greenhouse gas accounting framework. And it demonstrated how multinational companies today are applying different organizational boundary, right? And one of the great thing they have said very clearly, unlike our Reliance Industry Limited, they have taken all the subsidiary, right? 100%. And
Mhm.
that's the beauty. And see their rating. You can see that it's 31 compared to 39 of refinery company, and they are in exploration. Okay. So you can
Mhm.
understand they are in complete value chain, still they are getting better rating compared to the other firm. So my point and limited point is this, that every company has their own long-term energy transition strategies. For example, Shell has 2030 as 50% reduction, 2050, 100% reduction for scope 1 and 2. And they have selected C, operational boundary for scope 1 and 2, isn't it?
Yes,
That's
sir.
the beauty. While equity boundary approach they have taken for
Scope
scope 3.
3.
So that gives a new idea to you guys, right? That you can put a combination in the beginning itself, the baselining time, right? And it also outlined that company net zero roadmap and their operational target, methane reduction targets are in alignment with the international standard, specifically GHG Protocol and ISO 14064-1 requirement, right? And that's the best part of your, presentation. I liked it. Of course, you can always reduce the background informations, etc., while you are
Yes.
talking about it, and explain the why in operational control. That could have helped a
Yes.
lot, right?
Okay.
Like operational control approach, if I have to
Mm.
explain others, I would have told them that it ensures the accountability of Shell, Madhurendra, right? For emission rest, with them, they are saying that if I am the one for which everybody is emitting, I am the one who is emitting for my own company, I should be responsible for it, right? So I take the accountability of the emission with the entity which is actually emitting it, and then I will manage the operational risk. I will make governance structure, assurance structure, and eventually I will achieve my performance management more effectively. And that is why they have taken operational control in scope 1 and 2 rather than 3. Okay. And yes, Madhurendra, you have additional questions, go ahead and ask if you want.
Yeah, sir, for a service sector, if we consider an equity boundary for scope 3, then it will be basically reduced to zero, I think.
Why you say that?
Suppose I was thinking about a bank where I am working. So my scope 1 and scope 2 are actually very less. Uh,
Correct, 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 correct.
and scope 3 emanates from what I am financing. Right? If I am financing something which is, say I am financing 75% of a company which is emitting 30 tons of CO2, right?
Correct.
So if I
Yes.
am, so my share will be 75% of
30.
30.
Yes.
If I consider equity boundary,
Yes.
right? But if I consider operational boundary, then I do not have any control on that
That
company.
is why, even that is exactly why Shell has taken equity in the scope 3. And
Is it not cheating?
for you guys, there is a PCAF as well, if you are aware about. For investment, there is another methodology.
Yeah, I have heard about PCAF.
Yeah, Partnership for Carbon Accounting Fundamental, it is called.
Yes.
And that they provide specifically for a scope 3 category 15 emissions where you do investments, right? You can deploy that and calculate the emission. And that is the reality, right? You are just taking a 10%. You will never take 75% in any company. You will take 10% max. Loan you will give, right? So loan calculation is
Yeah.
completely different because then you are raising also fund for that purpose, right? You are taking money from different companies and putting into a green product, and that product, through product, you are investing. And by the way, just to let you know, Madhurendra, you work with Bank of Baroda. The best part of banks today is that the moment they label one of their funds as a green, their rating increases by several bounds and leaps. Are you with
We
me?
have some, yes, sir. We have some 2, 3 products labeled green.
You have to put into your sustainability report, show the progress, and you will see the rating from each company will suddenly increase by 2 to 5 notch. Okay, in 100, we have 100 notching in India, right? So if you are at 70, it will become 73 immediately because product has a huge value. So good question there, Madhurendra. I hope I was able to answer.
My understanding is that it's not allowed.
What is
You
not allowed?
cannot you cannot apply the operational approach for scope 3 for your green bonds and all, as per GHG.
I didn't get you, means what you are trying to say.
Saying that bank just to escape from scope 3 emission reporting by resorting to the operational boundary approach is not permitted as per GHG Protocol Standard. It has to be specifically for a green bond pilot. It has to be equity investment.
Okay. That may be they prohibit a specific calculation method outright. I have not seen that happening. But if you have observed somewhere, please take a screenshot, share with everyone. But that's nowhere specifically they have come in the books and said that outright they are prohibiting any specific calculation method. They never said that. It depends upon industry and it depends upon the what kind of portfolio you have. Yeah. Clear, everyone? Yeah. And if you find it out, please share with others as well. That will be a good education. Yes. Not ChatGPT ones, the direct source. Okay. So anyone else? Who is going next?
Hi, sir.
Yeah, please go ahead, Nilesh.
Yeah. Is visible, sir?
Yeah. Your screen you meant to say?
Yeah.
Yes. Can you make it full screen? So it will be readable. However, your font is very good, so we can read it easily. Go ahead.
Okay, thank you for giving this opportunity. I taken a company review called the Alcom. It is founded in 1912. It is basically Switzerland company. It is operating in 45 countries and also in around 63,000 of employees were employed and operation sites for 2,300 operation site. It is going to operating. And they are mainly into in cement aggregates and ready mix concrete and also in asphalt and advanced building solution. And also we can see they are in low carbon cements and also they are recycling the circle these concretes and all recycling. They are using recycling material and also they are using technology on everywhere. When come to the base target calculation in the year 2020, their base emission was 10 million tons of CO2 and their target of 20% by the year of 2030. Uh, when come to it's around 88 million tons of CO2 emissions. Here we can see they are achieved a lot target emission as per cap. It was in 8 million tons of CO2 emission. Actually, they are emitted is 7.85 million tons of CO2. They are in around 1500,000 below the cap. This balance sheet will be explained in the next slide. And a factor there consider existing environmental management plan and also in planning and capital investment and also fuel switch opportunity, renewable energy investment, energy efficiency, operational improvement and industrial benchmark and also in cost effective emission reduction opportunity. These are the factors they are considered for setting the target. We can find this emission liability and also in compliance instrument. One is GST emission, one is GST asset. In the emission factor, they are considered direct emission, indirect emission, and also in value chain emission. Totally, they are around emission offset is around 12 point metric ton. When it is balanced, they are to balance these emissions. Some of the alliance through the regulatories and also they are also in purchase the carbon credits and also in regulatory cap upset. They are done to achieve these goals. We can find here voluntary cap. They are set for just for example, they are set emission factor like 9,000 tons of million tons, and also in regulatory caps like European Union, some alliances they are providing. By reducing these, they are taken some alliances and also in purchase and emissions alliances, and also these CMD credits, it mean clean energy credits. This is also valuable for their assets. When come to this, how their uh, wherever there will be in some problem, some of the times there will be in double counting. For that, they are done two things. One is sale of carbon credits and sale to the buyers, and another one is overlapping the targets. Some of the times it will be overlap with two or more these things. So they are come up with those things and they are overcome and they have set the target. Uh, and when we consider these outcome, this we consider the Canada, United States, and the European standards. In Canada, there through the asset, there are around 1,200 tons of CO2 and emissions. They are also transfer the 10,000 tons of CO2 to USA. From USA, they are taken 10,000 from 10,000 tons of CO2 emission from Canada, and also internally they were sold to European Union 5,000 tons. There they are balanced and internal transfer also consider and external transfer also, and double counting was eliminated. So when consider the overall things around 7.8 metric tons of these things, they are generated through the assets and through the emissions. They are generated around 6.9 million thousands of tons, and they are in the 10,000 net external transactions. Okay. The benefits is transparency, regulatory compliance, corporate target management, double counting prevention, this global consistency, better decision making, financial ESG reports, and critical analysis. They are compare the scope 1 and 3 accounting and clear guidance on emission factors, provide a double prevention of double counting and transmission loss, and also recognize the transmission distribution losses and particular flexibility and traceability. Some of the area they need to implement is the limited guidance on renewable energy and no quantitative examples and limited decisions and data quality, minimal guidance development and limited distance. These are the things which I came to know in this. Is there any questions?
Oh, great job, Nilesh. So what a case study. You have definitely used outside research in this, didn't you?
Thank you, sir. I think I prepared around 20 slides,
Yeah, but
but
awesome job.
after
This is not there in the book. What you have presented, the balance sheet, GHG balance sheet, is definitely you have done a deep research. Must be used some, you might have used some LLM, but great stuff. See, this gives a learning that you can present GHG accounting definitely not as a compliance, not as a core competency, but even as a balance sheet. That's the beauty today Nilesh has talked about, that he has shown you liabilities, which is their GHG emission, and then he has shown you assets, right, which is REC and reduction targets which they have taken. And then he has gone in detail and explained you through this one live example of Holcim 24-25 data, that how this company is using regulatory market, it is using voluntary market, and it is taking a benefit from both the market in their advantage, right? So, of course, I love that he has also given the context that is a Swiss company, and in 1912, more than 100-year-old company, right, with 63,000 people all across world. And of course, they have a major problem in European Union, where they have been imposed with the mandatory requirement. But instead of all these challenges, a legacy business, which is in the sector of cement, aggregates, ready mix, and advanced building solutions, where only pollution and particulate matters and calcination, low carbon challenges are there, but they have deployed low carbon and recycled concrete, that is their product, and they saved 7.85 thousands 785,000 tons of carbon dioxide, right, conforming to 8 million tons of regulatory cap. And that cap, sorry, 7.8 million, yeah, 7.85 million, something like that. There is, when he was speaking, he was not very punctual on the thousands and millions. But point was that they took 2020 as a baseline, where they had 10 million tons of carbon dioxide emission happening, and they have a target cap of 20% reduction in 2030, where they want to reach 8 million. They have already achieved 7.85. This is what a dedication and commitment to your capital to in this direction gives you the benefit. Yes, and they are, means, of course, I was supposed to talk about Tesla, but this is another good example of cross-border carbon accounting and double counting prevention, which he showed you on the sheet. Yes, Nilesh, great job. I think you should share this PPT in the group. Everybody should share PPT in the group, and people should exchange main group, not only in the group one, or sorry, group two you are, but in the main group, cohort 25. Nilesh, do that, right? People
okay,
can
sir.
go and read it and get benefited. Of course, there are some word blurred, etc., but that's a chat GPT or Gemini problem. But that's not your problem. You did a great job. Thank you very much. And I hope everybody got benefited and
Thank you.
everybody clapped for you. Guys, please go ahead and clap, and let's go to the last person in the room who is going to take, Yashwant and Kalpak, both of you are pending. Go ahead.
Hello, am I audible?
Yes, you are, Kalpak.
Okay, just a second. Before I start, I'd just like to thank Dhaneshri for her presentation. I actually took up the same topic, so I'm glad that she did justice to the numbers, which in my case would be a little different. I hope my screen is visible.
Yes, visual, very much.
Yeah. So let's go to the first slide. Um, this slide introduces the core idea that strategy alone does not create value, right? The execution of it does. Shell designed the target cascade to ensure that corporate objectives are translated into meaningful actions across every level of the organization. Um, now, when we speak about this, they design it as such that uh, in this slide you'll be able to see why it basically existed in the first place. Large organizations, as I believe someone just said, often face the struggle to convert strategy into execution, right? And Shell addressed this by cascading corporate objectives into measurable responsibilities. The goal here wasn't just accountability, but also strategic alignment through all sections of the company. Uh, but if everyone has different roles, should everyone still have the same targets? That's the question that comes to mind. Uh, that's where the next slide comes in. Uh, yeah. Different organization levels would require obviously different performance measurements, right? Corporate success is measured through absolute outcomes, while facilities focus on efficiency, and intensity because they operate under different constraints. Uh, like one of the most interesting aspect of this case is that Shell doesn't impose identical targets everywhere. Uh, Corporate leadership uh, measures absolute emissions and enterprise performance, whereas facilities are evaluated using intensity and efficiency matrices. Because each operates under different technical and operational conditions, and different matrix would be there, but there would be only one strategic direction to the entire process. Now, once those targets are defined, the challenge becomes ensuring they are executed consistently across the organization. So that brings us to the next slide, which would be the cascade flow and governance side of it. Now, corporate strategy is cascaded through governance structures to business units and facilities, obviously. Uh, the central oversight provides consistency, while the local execution provides the flexibility that is required to carry out the reporting structure as well. Now, this cascade isn't simply about distributing targets, and it's more about distributing accountability within the structure itself, right? Uh, so uh, Here, corporate leadership defines the strategic direction, while as facilities decide how to achieve it. The governance, in the same gist, what I can say is the governance ensures alignment without removing the operational autonomy. And it's a balance between the standardization and the flexibility that the facilities provide. Now, of course, a governance framework is only effective if the performance can be actually measured. And that's where the last slide comes in, which would be the KPI architecture and governance side of it, right? Now, KPIs provide the quantitative foundation for the target cascade, right? They allow Shell to monitor the performance objectively while also supporting the governance and continuous improvement objectives. What gets measured gets managed, but what gets measured also shapes the behavior of how people work. Uh, and here you might be able to see that Shell integrates financial, operational, safety, and environmental KPIs into one performance framework, right? Governance mechanisms ensure transparency, consistency, and accountability through all these sections. The challenge is ensuring KPI the challenge here is to ensure that the KPIs encourage the right behaviors, not just better numbers or closing statements, right, on a particular report. So overall, what I would say is what I found the most compelling about this case wasn't just the target cascade itself. It was the philosophy behind it. Like, Shell recognized that organizations don't execute strategy at a corporate level, they execute it through thousands of individual decisions made every day. The target cascade ensures those decisions remain aligned even when the matrix differ across business units and facilities. But what stood out more to me was that the real reason is that effective governance isn't making everyone work the same way. It's it became about ensuring everyone moves into the same direction, right? So in the end, the performance management isn't simply about achieving targets. It's about creating a system where strategy, accountability, and purpose reinforce one another to deliver the long-term value that they are trying to achieve. So eventually, the only way I would like to end this would be to say that a target cascade doesn't align KPIs, it aligns decisions that are made throughout the years when people follow the target cascade, right? And in the long run, organizations are shaped not by the targets they set, but the those uh, decisions that those targets inspire. And yeah, that would be the way I would like to end the presentation. And yeah, thank you. I hope I did some justice to the
Indeed,
case
indeed,
as
yes.
well without the numbers.
Your takes are completely different than what she has done. So good job, you both of you doing this work shows that every individual has a different thumbprint, and that's what you have done there. So really appreciate that. That work shows here. Now let me hear from Yashwant. You have prepared your presentation, Yashwant? And then I will give the feedback to both of you, and then we'll close the session. But meanwhile,
Actually,
everybody.
sir, I try to cover that UTC, that company, and that
Okay.
chapter identifying the GHG and calculating that. So I just gone through that chapter and I couldn't prepare that I mean that presentation. So today was my first that time homework how the team was I mean, presenting. So definitely in the next time I'll definitely I'll present my the PPT and cover that. So I sorry for that I couldn't cover that.
Okay, no
But I
worries.
joined that how the team they presented and how they have done the case study because this is the first time that I'm going through that. So that's the reason, sir.
No, no problem, no problem, no problem.
Yeah.
Totally
But I
fine.
joined that how the team is they are doing. So
So tell
next
me
time
your
I
feedback.
will.
Tell me your feedback. How the team did. How team did.
Yeah, team. I mean, they have done very, very, I mean, good job. And mostly, I saw in that group, Ramendraji, he was, I mean, supporting the team. Please, I mean, set the, I mean, context, set the example. How? So it's a learning that, I mean, for me, it's a very, very good learning. It's the first time, so definitely it will help to me as that whole
Okay.
team they are doing the brainstorming and then they are doing the great job. So
Okay.
I mean, it's inspiration for me, sir.
No, no, I agree. And good you observe
Yeah.
that. By the way, 10:30 again, I will be giving extra half an hour to guys who could not join today, right? So they can
Mhm.
come early, so you can present on that day. 5 to 10 minutes, don't exceed your slide beyond that on UTC,
Yeah, yeah,
and do the presentation because that's how you will come out of that shell, right? Of
yeah,
being not confident. So try it. It's an opportunity. I am ready to work extra half an hour for you guys. Whoever is missed today should present it. Thank you very much, Yaswant, and looking forward to your presentation. So, if it is
yeah,
your first time,
definitely.
so I would
Yeah,
definitely recommend that you should try. Now, let me go back
yeah,
to Kalpak job. Kalpak, great stuff. Please clap everybody for Kalpak. Uh, your presentation, of course, has explored other side of the shell that how the target cascading framework works, right, Kalpak? So that itself demonstrate that how corporate sustainability strategies in company like Shell is built. Specifically, again, you have emphasized the same thing: governance, accountability, performance management, which is the three strong pillars of corporate sustainability strategy. And there, rather than they treated sustainability as a standalone function, the case which you illustrated, by the way, your slides were really interesting and means anybody who is from a startup segment, they would have loved your presentation. Now, you have illustrated the strategic objective, which has eventually cascaded to corporate leadership, and that actually cascading to business unit in such a large company, right? Which has business units,
Yeah.
SBU. They have several SBUs. They have operational facilities, and then still this cascading has ensured that every level contributes towards a common organization goal of the Dutch Shell, right? And retaining that operating flexibility. And that's the beauty of your presentation, Kalpak. Awesome job. Yes, you
Thank you,
emphasize
sir. Thank
that
you, sir.
successful ESG implementation depends upon not only setting ambitious target, but people like you who can cascade down that to day-to-day activity and decisions while not losing the sight of long-term strategy. That's exactly your presentation is. Yes, please share
Yes, sir.
that in the group, and that will
Definitely, sir.
definitely help others to learn from it. And maybe next time when other people are doing, at least we'll get inspired. Thank you very much, everyone. Great
Thank
job.
you,
I
sir.
will not be taking any class today, right? But I love the session. I hope everybody has learned today. Learning must be 10 times the normal class today. Yes. So clap for your own self before you leave, and take care and see you on Saturday. 10:30, I will give another half an hour to other members who could not join. Ramanan ji, kabhi kabhi, let's be,